we've done okay. But I think when Greg and I joined some 9 months back, we said, well, we're going to do 150 million this year, having had a bit of a slow start to the year. People were saying, how can we do that? But now we're here, and we're hitting those targets, and we're on track to hit that milestone. And I think is creating that belief and just consistently every day showing up and being almost looked as a little bit as a crazy person, running around in the town square saying we can absolutely do this because we know we can. And now we're starting to see that belief, people buying into the dream. They see 250 million is not out of the realms of possibility, even though we've never done that before. Is that we grew the lending by 90% in the last 2 quarters of last year. So with that growth, we continue just to see that's very attainable. And it's not growth just been driven by lowering our standards. On the contrary, we've actually heightened our credit standards. We want to be underwriting the right kind of business, but that also means that we're not wasting our own time, our funders' time, or more importantly, our brokers' time.
Welcome to the Property Funder podcast. I'm your host, Michael Dean. You can find me on the internet at property_funder. I'm here today with Jacob Bouet Andersen. I'm sure I don't ever pronounce that right.
Close enough.
Jacob is managing director of Avamore, or co-managing director, focusing mainly on the credit side of the business. Jacob, great to have you here with us today.
Thank you, Michael.
Good to see you.
Likewise.
Jacob, you're a new dad. How are you finding that experience? How are you finding that transition?
It's well, that's been quite a journey, and I'm surviving on a combination of coffee and sheer determination
and vibes. I think as that I say.
As well. Yeah. It's been she's just turned 2 months old, so it's been quite an emotional couple of months, but fantastic at the end of the day. So that's what we're all aiming for.
And is she doing well? She's growing nicely.
She's
following the charts.
She's following the chart. She's chunky and small like myself. So so all in all, good news. We went to the doctor last week, and everything's absolutely fine.
Nice. And it's been 9 months since you joined Avamore. Yeah. It's been bit of a baptism of fire, and just keeping things nice and simple by having a newborn in the middle of it as well. Yep. How you feeling like you're settling in?
It's been good. It's been a journey, of course, and there's been a lot of transition in the business, but I think we're in a very good place now. We've made some changes to the team, we made some changes to our products and all, but I think we're in a good place to grow from now, and we've done some work on the funding as well, so we're sort of setting ourselves up for very, very busy 2026, 2027, when we're looking to beat some records as well.
And I think since Greg and yourself joined the business in the last 12 months, you've sort of overseen a bit of a turnaround in the fortunes of the business. Do you want to maybe just share some of those with our viewers and listeners?
Yeah, sure. So I think one of the key things is we've grown origination by north of 90% in the second half of last year. We saw a big flurry of deals come through in the fourth quarter through October, December, and very, very busy run up to Christmas. So we've grown the book, and we continue to see good performance on the loans we've written. In addition to that, we've managed to reduce the amount of NPLs we have in the book. So we've managed to work out a lot of the scenarios, get out on the other side with some good results on balance for most of them, I think, and still no capital losses, as we continue to be proud of. And in addition to that, we haven't added anything, touch wood for now, any more NPLs to the book. So we're managing the book very closely. Some of the loans are naturally higher risk than others, but we walk in with eyes wide open, and we underwrite the risks. So we know we underwrite in a way that we can. We're not staying up late at night every night and keeping ourselves awake for taking on risks we shouldn't take on. So we've been quite conscious in that approach.
Yeah, I think that's it's one thing. It's one thing working out NPLs off the book. It's one other thing adding to your list of problems. Yeah. At the same time. What do you think's the key lesson though to maintaining a clean book, or helping that loan book stay cleaner?
It's proper underwriting on the way in, structuring the loan and making sure you take the right kind of risks. At the end of the day, we're backing people, and I think there can be an element of looking only at the product when you're looking at development deals or any lending and any real estate deals in general, where it goes back to the location, where I think in this market we're so more dependent on the actual delivery and the sponsor. So looking at the track record of the developer, looking at the track record of the contractor, local supply chain, and the delivery as a whole is one of the key aspects of what we do today. In addition to looking at the financial aspects of their involvement, how much money do they have in the deal, how much money will they be looking to make, are the costs properly underwritten, is the valuation realistic and achievable, and looking at all that. And then, of course, in addition, looking at building the right product for the right market.
But I suppose once you're in the loan, like, you know, with the even if we look at some of the NPLs that we've just seen run off, I wouldn't necessarily say that those loans were terribly underwritten. I think some of it is just boils down to the management. Sometimes if you know, the decisions you make during the life of the loan can sometimes have, you know, sometimes good consequences and sometimes less good consequences. What are the key things that what are the key differences do you think that we've made to how we manage loans so that we aren't adding to our list of sleepless nights?
We've taken a much more hands-on approach with the ongoing monitoring, and we're very quick to flag risks, and we've taken an approach effectively of looking for smoke rather than fighting fire. So every time we see an issue coming up, we'll pick up the phone, call the developer, go through that, what we think the issues are, what we think the risks are, and work with them proactively to ensure that we avoid any material issues continuing to go wrong. And I think we bring in hundreds and hundreds of deals of experience that a lot of the developers we're working with have not undertaken, because you couldn't do that in one lifetime as a developer. So we've seen the risks materialize several times, and we know what to look out for, and we bring that to the table. So we take much more of a partnership approach with our developers, not only on the way in, but also on the way out and on the delivery.
Yeah, and obviously seeing that firsthand, you know, seeing your list of problems diminish firsthand is obviously nice to see, and it means that we can then focus as a business on growth rather than firefighting, which I think, you know, at this stage of the cycle that we're in is a enviable place to be. And we know, you know, from a number of other peers in the market that anyone who tells you that they haven't got loans in default or problems is lying, and it's ultimately the focus has got to be on minimizing that and then return your attention to growth.
Yeah,
I suppose. In terms of that sort of growth focus, what are some of the key changes that you've been pushing for and driving with the broader with the broader management team, particularly on the underwriting and execution side?
We've taken a much more intense approach to underwriting. We're trying to make every deal work. We try and look for solutions where others might see problems. And we try and make sure, when we look at a deal, we try and find a way of doing it. We try and find the deal we want to be doing. So there might be a deal where the valuation comes in either too high, we think, well, we can take a view and we can reduce the leverage, or too low, which is quite often been the case over the past 6 months, where we take a view and say we're happy to go slightly above our original LTV covenants, stretch because we believe that the market is there for it, it's the right product, and equally it's a good developer. So we're looking more pragmatic at the risks that we're underwriting. And we maintain that view that we discussed last time, so call back to that, where we're looking at things as an investor. So we're not necessarily just looking at it from a debt perspective, where it's in and out, we leave it, and then 18 months we hope you pay you back. We take that hands-on approach with the asset management, and sometimes we take risks that other lenders either wouldn't understand or wouldn't be comfortable to take, because we have a strong asset management team who can get involved, who can help out, and we can take risks that we can get comfortable with because we understand it, and because we can mitigate it, or because we can get third-party security elsewhere to prod up that risk effectively. I think that's on the underwriting side. That's it. We're focusing very much in execution as well. So we're taking a more hands-on approach with solicitors, making sure we communicate with them, communicate with the brokers, and taking ownership and accountability of getting the deals done. Because you sort of get into a mix of a brokers, lawyers, professionals, lenders, and everyone seems to be looking at each other rather than somebody taking control of that transaction. And we've decided that that'll be us. So we drive it. If anyone else wants to drive with us, absolutely fine, but we want to push it forward. In addition to that, we continue to invest heavily in the tech. So we're rolling out quite interesting new features to verify assets and liabilities, which in turn can be used to verify ownership and track record. We are increasing the operational predictability of valuations, cost analysis and all that by running BCIS automatically for every deal we see. So a lot of the due diligence has already been done before we issue heads of terms, which gives us a higher level of certainty that we can get the deal done because we've already checked the numbers. We know that we believe in the valuation, we believe in the numbers, then it just boils down to the delivery and then the execution.
And it's not uncommon for underwriters in various businesses to unnecessarily pull at threads and sometimes go a little bit too much into the weeds on, shall we say, non-priority items, and then sometimes missing, the big items over here. What changes have you brought about that kind of reduce the sort of, as Zaher would put it, the midwit in the execution side of things, where to streamline and simplify and maybe again going back to the point around predictability, deliver a low friction, more predictable outcome for brokers and borrowers?
A few things. So we've introduced a few different frameworks that allow us to assess risks in a slightly different way probably than what the market does. We're looking at probability of something going wrong and the impact if that does go wrong. And we have the 4 quadrants being high probability and high impact, meaning that we need to mitigate that. That's quite often part of the legal process, but we can insure our way out of that. That can be legal indemnities, anything like that. In addition, we have low probability but high impact that we also need to insure our way against, and high impact, low probability. So there are a few different aspects we're looking at. So we're looking at risks in a more dimensional way rather than just in a vacuum for individual things. And we're looking at assessing all the risks as a whole rather than individually. In addition to that, we've implemented what we call our Avamore 4 pillars of credit, which is the product, the developer, delivery, and the financials. So again, going back to the point about the sponsor being critical to that. And we're probably looking at, if not 3 out of the 4 being really on the developer, then at least 2 of them being so focused on the sponsor. So we're underwriting with more purpose, and we're underwriting the right kind of risks. And thirdly, we've changed the process a bit to be more dynamic, so we get the deals through the machine, and it will hopefully we're already starting to see that, where it flows a lot more efficiently with more continuity within the team. We have the tech running the analysis up front, so we know we have sort of the foundation have been laid, and we know that the team who's picking it up throughout the journey are all in communication with each other. So there's no point in time where new people being introduced to the process that coming in completely fresh.
And so I suppose for brokers and borrowers who might be watching and listening to this conversation, what would be the key message you want to get across in terms of the improvements that you've made, that you're overseeing as far as that underwriting and execution side of things is concerned?
I think it's that communication is a lot clearer and a lot more on point. We're trying to come back to people within very tight SLAs. So we're giving our underwriters a day to respond. We're giving them very certain and very strict milestones in terms of getting it submitted to credit for sign-off, so that there's no extended periods of uncertainty for brokers and for borrowers who are making decisions on the back of the information we give them. And in addition to that, we also want to make sure that what we communicate is accurate, and we're flagging any risks or concerns we have up front so that they have time to mitigate it. Because the worst thing you as a broker can get is you're 5-6 weeks into a transaction, you think you're completing next week, and all of a sudden 20 questions come up, all of which are either could have been asked before, we have the answers, or to an extent some of them are midwitting. So it's making sure we ask the succinct questions up front, we understand what the risks are, and we communicate throughout that process.
Yeah, I think it's really important, to give clarity about what's outstanding and what's required, and really giving clients and brokers a real sense of how close you are to the transaction closing. Because I think one of the worst things you can have as a client, or as a broker is that sense that there's some sort of never-ending saga. And because if that's the case, then you're just going to be less committed to the process, aren't you? And you're going to feel like, do you know what? I'm not going to provide the information in a timely manner, and I'm not going to supply my solicitor with whatever they need when they're asking for it, because it's like, well, whatever I say, I'm going to get another 30 questions come back after that. And so I suppose from our perspective, we need to give really good clarity as to how close people are to the transaction being ready to close, and absolutely minimizing the number of questions that we ask, so that we can get to that finish line sooner. Because some, maybe not necessarily ourselves, but some people in the industry have a tendency, I think, to just keep pulling at threads and getting answers to questions that won't ultimately make a difference to whether they make the lend or not. I guess from our perspectives, it's about essentialism, right? What is essential to getting the deal done and making a decision on the deal, first and foremost.
Walking in with knowing what you don't know about a deal, and then identifying all those key risks early on. And as you say, there's quite a lot of questions you can be asking for the sake of asking them, but the relevance is questionable. And there might be certain things where you definitely need the answer to, or key due diligence items you need to get out of the way, but you're asking them whether or not what kind of kitchen they had in their third development. It's irrelevant. Did they sell it? Did they build it on time? And show some pictures. You can sort of form a view on the basis of that. If you need to, you can go and visit them, but quite often you can form a fairly good view of what they've done in the past, or pick up the phone and call them to get that understanding of what they've done.
And in terms of legal professionals, legal panel, are any changes afoot in terms of how we engage with our professionals, and and particularly on the legal side, and are you looking at a bit of a shake-up of the legal panel too?
We are. We have been, throughout the past, I'd say 3-4 months, we've been talking to quite a lot of new firms to come up on our panel. We've also been working on a certificate of title we're probably looking to roll out over the next couple of weeks already. So that will help us streamline the process, and part of the narrowing down of the panel is also who's willing to work with us on that basis, which will make execution a lot more seamless for us and for the other side, for the brokers and borrowers as well. So we're doing a bit of a shake-up. We're working with people who are communicative, who understand the pressure, but equally who understand and view risks in the same way as we do, and take a pragmatic view. And you can try and indemnify you out of every situation, but sometimes if you look at the probability and impact matrix, you will have things that sits down low probability and low impact, and then we shouldn't really be worried about that. If anything, that's an equity risk that we can sell. Can you sell this for £5,000 more or less? It doesn't impact our basis. It doesn't impact the title. It doesn't impact the overall whether or not we should be doing the deal or not.
I mean, I had a lunch with a solicitor last week, and I think and it really dawned on me just from a couple of comments actually, that the impact of moving from their sort of very detailed title reporting to the certificate, why it's going to be really beneficial. And I think when you present too much information to an underwriter, an underwriter's natural instinct is to pull at the threads and get under the skin of things. Where actually our underwriters, I think, you can kind of elaborate on this a bit more. We're trying to convert them less as underwriters and more as deal executors, right?
Yeah.
And so if you effectively have a lawyer say to you, subject to the disclosures in this, we're good to go, or we're good to go, and just check the disclosures, as opposed to here's a laundry list of findings in the title. What more would you like to know? If you put that in front of an underwriter, I think the tendency is going to be, okay, well, what about this? And what about this? What about this? And all of a sudden you've got underwriters asking to look at all the searches on a transaction when ultimately they're not qualified lawyers and they don't really know. They're not really trained to look at searches, and ultimately they're certainly not more trained than the lawyers are to look at the searches. So what benefit they get from looking at those in any detail is a good question. So, and that was one example that was raised by the lawyers as by the lawyer we had lunch with as a key benefit of that. So I do think that would be helpful. But yeah, where do you think that that's going to be a big benefit?
I think so, yes, personally. I think when we look, it's actually an interesting dynamic to have, because a lot of the underwriting is naturally focused on the legal, which in its very nature, you're signing a facility agreement, you're signing up to the legal requirements and covenants under the terms. But at the end of the day, when we look through the post-mortems on some of the loans that have gone wrong, it's never because of something that was written in an ROT. We naturally need to make sure that we have a marketable title and we can sell it and there are no ransom strips. But when you actually see what have gone wrong on site, it's very, very rarely, if any time, we've really seen that. An issue that the documents weren't executed properly, or that the ROT did not contain certain disclosure about certain items. It always boils down to delivery, the values, the budget, or anything like that. So when we're looking at it, we're spending an inordinate amount of time trying to understand every legal nuance of a deal, most of which is irrelevant. And if we have solicitors working through that as the experts on it, say there are nothing on this transaction that poses a significant risk to your capital or to the actual exit of the property, that's fine. And it's equivalent of us to an extent, because we're not lawyers, we're financial professionals. For us to read through the ground investigation report, we understand enough to be dangerous, but we wouldn't be able to opine on what actually in the ground and whether or not we should be building that or this kind of foundation. We leave that to the experts. We leave the summary and we move on. Same with the certificate. We'll have the executive summary effectively in the back, and these are the key risks. This is what we need to mitigate them. This is what you need to be aware of. The rest, to an extent, don't worry about it. It's all fine.
Yeah, I think it's going to be interesting to see how that plays out. Do you think another benefit of moving to that certificate of title also means that the training and the development of underwriters will get easier, because you're lowering that bar or threshold for someone to start executing and underwriting deals by effectively removing that, the level of legal expertise that's required to do that kind of deal?
Definitely. You can then focus on the actual fundamentals of the deal, the four pillars of credit. You can look through the deal and assess that as an investor. You can see, should we actually be delivering this product for this market? Should we be backing this developer? Are they building it in the right way? And are we providing the right leverage to compensate for the risks and the returns we're making? Rather than sitting and going through legal documents and conveyancing and covenants dating back to the 1800s, which at the end of the day we don't really understand how to mitigate it. We don't understand what the impact is, so we'll have to take the legal guidance on it. We can take that and we know it, we understand it, but then at the end of the day we leave that with the experts. Getting new underwriters in will be a lot more of a focus on the actual execution and the cadence of a deal, and then looking at the fundamentals rather than going through a legal degree just to understand development, which in its very nature is quite simple.
Yeah, I think that's right. I think ultimately there's always that danger of not seeing the wood from the trees. So
yeah,
I think we're going to just change tack slightly. You were one of the authors of the residential market outlook that Avamore released a few weeks ago.
Yeah.
What were you? If rather than stealing your thunder, maybe you can just outline the key points, the key summary items from that, and maybe we can touch on discuss some of those in a bit more detail. We wanted to get something out the market to show what we see, and we naturally have a fairly well positioned portfolio, and we have deals all across the country, and we continue to see a lot of that regional convergence, and we need to see the regional renaissance that we've seen for the past couple of years, where deals they make more sense when you go further away from London. Naturally, the liquidity is less, but we see better and more solid transaction values. We can underwrite it a little bit more accurately, and we see better yields on cost and yields on the values. So I think from that perspective, we continue to see that the growth in the regions rather than in London. There is still
a very solid market in London, but I think people are naturally hesitant to buy because there's for the past many years there's always been something we're waiting for to happen, whether or not there was this trust or budget, then a mini budget coming, and now the autumn budget that came and went without really any significant impact. We have the war in Ukraine, we have war in the Middle East, we have basically wars going on everywhere around us, and the US wanting to invade Greenland, and if not, then they'll take Venezuela. So there's quite a lot of things going on, but the market we operate in, and that's one of the key findings as well, is we're so driven by the individual operator and the local market. And when you're building 2 or 3 houses somewhere in Wiltshire, we're not going to be impacted by big swings in the macroeconomic climate. We're going to be impacted by, are we delivering the right product in the right place and with the right person? And in addition to that, we sort of started to see a bit of a continual trend toward HMOs and the more income generating assets, and being a bit more creative than building a house, building 5 flats and renting them out. In order to make that work these days, the operators need to be a bit more savvy. They need to be building slightly more, probably more condensed, to be honest. I think people want to be building bigger houses and all that, but I think with where we have seen inflation go to, and we've not really seen land values compress as much as it probably should have when you're looking at the residual values. In order to squeeze out the profit, you need to be creative. You need to be building either HMOs, which is a market we quite like, or other kind of co-living, or going into sort of the first generation PBSA and upping them. We've recently did a deal where we were doing some changes to the cladding for one of the first generation PBSA assets, where naturally being built in the early noughties, it was not really up to spec for what we have today. So there's a lot of value to be created through that exercise. So definitely what we continue to see a trend towards rental and income.
This episode was sponsored by Avamore Capital. In property finance, you want specialists who understand development, refurbishment, part completed projects, and bridging deals inside out. Avamore Capital knows construction timelines, cost pressures, and what it takes to structure deals through market changes. Deep expertise, not surface knowledge. Solutions-led thinking based on what actually happens on site. When you're working with Avamore, you're working with people who get it. Learn more at avamorecapital.com. I suppose if we were to sort of summarise, where we see our appetite being at its greatest, it's small infill development sites of sort of 1 to 9 units for predominantly housing, less for flats, albeit not flats are not a no, but just probably it needs to be in locations where there's a viable rental exit as well. You'd say HMOs, as you said, and I agree with that. And then I suppose it's sort of, and if we're doing non-HMO flats, it's flat conversions or refurbishments, it's going to be in further north locations where the yields support a more solid rental exit. Do you see any resurgence in speculative development of flats, particularly in London and the southeast? Are there any conditions, any changes to market conditions that could make that viable later this year, or do you not see that as under happening realistically?
Well, I think we're seeing an uptick in inquiries, and we're seeing more developers come to us with ground up developments, which is a part of the market we really like, and where we have historically and currently doing a lot in. I think within flats, the buy-to-let market, well, the exit market remains probably a little bit uncertain, and it's not something we would necessarily walk into with a view to buy a big scheme and selling all the flats. We can probably sell some of them, but we will look to retain some of them as well. And that's the trend we continue to see, where I think developers, they might start to see that the base rate is continuing to drop, so yields should hopefully compress as well, so there can be a bit of capital appreciation and gain through holding it for a couple of years, stabilizing the assets and selling it. And at the end of the day, the country remains in a housing crisis, so delivering the right kind of units at the right price and buying well in the beginning will yield a return to good operators. And I think we continue to see that. What part of the market we really like is single family homes, where we have 3-4 units ground up being built in a location with good pricing dynamics, good supply and demand dynamics, and you're building in an area where it's built up, good quality housing already, and you're meeting a demand. And I think that part of the ground up is probably where we see most from a sales perspective. But the flats is, as you say, we do see an opportunity to get into that where there's a rental exit.
Yeah.
And that market is really, really hot at the moment, because a lot of the lenders out there, they're very keen to lend against income generating stock. And I think a lot of the banks who have gone through a bit of a probably extend and pretend period and are looking at writing a lot of new business, and they sit in very, very deep, big coffers of money they need to deploy. And if they can get good quality rental stock, that's definitely something they want to put their money out at.
I suppose from if I look back over the last 10 years, the majority of our exits haven't been through sales. It's been through refinances. I mean, the only time I'd say that sales have been the predominant source of exits was probably the sort of 18 months post lockdown, post the last lockdown, where the world sort of just opened up, and there was just sort of a feeding frenzy. But that, but either side of that, and very much the dynamic that we're in right now, it's been very much rental led.
Yeah.
I say rental, but what I mean by is it's been a refinance or term led exit rather than through sales.
Yeah.
And I think you actually know the stats on this, because you were talking to some of our funding partners around it more recently. What is that stat exactly?
It's just over 2/3 of the book that's been exited through refinances.
Is it?
Yeah, I think 67.
Okay.
That's been exited through refinances.
Yeah.
And I think it boils down to, especially when you're in London, where the price to income ratios are just not suitable for a sales exit.
Yeah.
We see that a lot more up north, where we have much lower actual price to income ratios. But down here in London, you're almost stuck in this perpetual loop of you're paying too much in rent, so you can't save enough, but you need to save up a year's worth of income just to afford to buy the house with 10% deposit. So without having any government incentive like the Help to Buy, which is quite helpful, a lot of buyers, especially the first-time buyers down here, are stuck in the perpetual rental cycle. Rents are going up, and it's probably I haven't looked at stats recently, but probably growing at a higher rate these days than income is. I know house prices historically have gone up a lot more than real income has grown. So that also almost, if you're not on the property ladder already, you're almost getting further and further away without having the benefit of the bank of mom and dad to come in and give you the 10% pay down.
Yeah, I mean, actually, one of the things that one of the pieces of news that launched last week, but obviously when this goes out, this is going to be sort of ancient history. Santander announced that they would have a 98% LTV mortgage, so you just needed a 2% deposit. They're unlikely to do that in isolation. There will be other lenders that will follow suit, and even though we're seeing lenders actually increasing their rates, as it looks like we're kind of going to get to that neutral base rate this year in the sort of mid threes, it does feel like maybe that might be the one thing that spurs the first time buyer market. And there are some anecdotal bits of evidence that suggest the first time buyers are now starting to pick up activity relative to the rest of the market. I mean, where do you stand on that? What do you think? And do you agree with that sentiment? And might that change how we view speculative flat development as the year progresses?
It opens up the market to a lot of first-time buyers, which is a key benefit, especially for smaller flats, 1-2 bed flats. But there's also an element of making sure that it fits the target audience. And I don't think there are a lot of people out there who's racing out to buy a 1-bed flat or a studio. So those will remain rental products for now, but building good 2-bed, 3-bed flats, which is cheaper than buying a house, is a good way for young people in the regions to come into the market, even in London. And while people might look at saying, well, I can rent a 2-bed flat, or I can buy a 1-bed flat, or maybe they can rent a 3-bed townhouse or buy a 2-bed flat. I think people would steer probably towards buying the 2-bed flat just to get on that ladder I personally would do that myself as well, and that's sort of where I would just to own your own place rather than continuing to rent and staying in that cycle.
Although it's probably will have less effect maybe on something that we would finance, but I think one of the things that I hear from the mortgage professionals that I engage with on social media that seems to be an issue around the flat market, the leasehold flat market, is obviously it's being the ground rent situation is kind of being dealt with legislatively now, but by capping ground rents, I think at £250 a year. But the thing that seems to be the biggest issue and a bigger issue is service charges, in terms of affordability, and where I guess purpose-built blocks where you've got first-time buyers quite possibly who've bought with Help to Buy are actually going to find themselves increasingly trapped with these with flats, which they bought with the Help to Buy mortgages, which are now worth less than they paid for them. And part of that is because first-time buyers who would buy those flats off them can't get the mortgages, not because they haven't even if you have that Santander 98% LTV mortgage, you've actually got your bigger issue is that when someone looks at someone's looking at your SAILI and they factor in the increased cost of the service charge payments, all of a sudden the bank is turning around to you, or your mortgage lender is turning around to you going, well, if you didn't have such a high service charge, you could service this mortgage, but now we're nervous about your ability to service the mortgage because the service charge payments are so high. So that's quite an interesting dynamic that we probably also I don't think it was touched on in the document, but certainly something that will be a feature that we probably need to keep a close eye on.
Yeah.
Probably actually also for some of our bridging activity that we look at as the year goes on. So yeah, I guess we'll have to watch that space. In terms of the asset management side of things, in terms of the existing loan book, where do you see opportunities and where do you see threats as the year goes on?
We're seeing quite a lot of opportunities through exiting through refis, and whether or not there presents an opportunity for us to refi the assets out is a separate conversation. But we continue to see a fairly significant part of the book being refinanced out, and as I said, the lenders in the market, the challenger banks, are quite keen to get good rental stock. So if assets are not selling, even if it's single family homes, there is still an option to refi them because they're dying to get stock. So we're working with a few of them, and we have a couple that we've seen a few times come across. So if we are coming up towards the end of the loan term and we're sort of seeing the leverage going up to a point where it's about time to refi, otherwise we're getting into that death spiral where the interest on our loan accrues so much they cannot refi us out to get a lower rate on it. So we're trying to push some of these towards some of those lenders. The threats continue to be in the delivery. I think exit is we see that reasonably fine, but the delivery remain a key issue, making sure you have the right people on the ground, you have developers who's not over trading, and you're just making sure you get everything delivered to the specification you've underwritten, because equally when you're in a market when you're in a buyer's market, the best stock will be sold first, and if you're not delivering to the spec that we're underwritten and we've budgeted for because of cost overruns perhaps, you'll end up with a product that nobody really wants to be buying. When they have the pick of the litter, they'll go to buy even buy an older house that they can themselves refurb, rather than buying a new build house with a premium with a quality that's just not really up to spec.
Yeah, so definitely something to watch out for. And then I suppose, kind of looking forwards, what's the stated aim of the management team in terms of the upcoming financial year, starting on the 1st of April? What are you all aspiring to achieve, and what are we, and where do we want to go from? Where do you see us going from there?
Well, we're building the pipeline now so we can hit the new financial year with a lot of momentum. We're creating new broker relationships. We've grown the sales team as well. We've doubled the size of that. We continue to grow that so we can get that flow of good quality deals coming in. We are working on making sure the process is as smoothly as we can so we can execute efficiently and in a timely manner. We underwrite the right kind of risk, and then once all that's gone, we manage the loans throughout the completion. And the management team we've set up is effectively one head of each of those departments who are going through professional growth as well. We have invested in training and resources for ourselves through management, coaching and consulting to build up that high-performing team. And the goal is, once we hit the 1st of April, having hopefully had a very good financial year that we're going through now, we're going to hit 250 million plus in the next financial year. So in order to achieve that, everybody needs to be working effectively together, efficiently together. And we need to have the same goal in mind. We have to all work and sing to the same hymn sheet. Right now, we're getting there, and I think we're starting to see a lot more collaboration amongst the teams rather than having individual units. It's all operating as one process. And we want to make sure that we get a business where the service level is consistent. So a broker comes to Avamore, it's not dependent on the relationship manager, it's not dependent on the underwriter, it's not dependent on the asset manager. Everything is consistently hitting the same high standards and the high expectation we're setting to our team. And in addition to that, rolling out the tech, which we're finalizing to have a full-blown use across the whole business in the next month and a half, would also allow us to have a lot more operational predictability, so that 250 is attainable. It will be a lot of hard work, and it will still take a lot of effort and conscious decision making from our end to achieve it. But we firmly believe that with the right team, with the right tech, with the right clients and brokers and capital behind us, that's a very achievable goal.
That 250 million that you talk about, that's, in your mind, that's a stepping stone, isn't it? That's not the final destination. Where do you sort of see the next 2-3 years in terms of lending volumes and business size?
I think where we'd cap out, I'm not entirely sure. It depends on a multitude of factors, but definitely the 250 needs to be a growth and a step into a new era of Avamore with a growing team, growing presence in the market, and more funding as well behind. We have very, very good funding lines right now, and our partners are incredibly helpful, flexible, and they share our view of risk as well. So that makes the operational management of that very, very easy. We have more than enough right now to get to that stepping stone, but just growing the book and growing the exposure to the market through different additive products as well is going to be key to get that. So one of the things we're exploring is adding more products to the portfolio, and we don't want to grow beyond what we can do, and we don't want to be a jack of all trades and master of none. We want to add in products that makes Avamore a solution for brokers as a one-stop shop almost, where we can come in with initial bridging for the acquisition, we can provide the ground-up development, we can provide potentially some exit bridging as well. So the whole ecosystem sits with us, which will allow us to grow the book and provide a much more suitable product in the market, and a product that is beneficial to both brokers and borrowers and ourselves and funders.
Yeah, I mean, I think some of the numbers we've talked about, I suppose beyond the next financial year, 350, 400, I mean, even as much as $500 million at some point, maybe by the end of the decade. And like you said, the decision to start opening conversations with new funders is not to take a share of that, 250, but it's actually looking at, is that, as you say, that complementary offering? It's, can we start to look at something that enables us to capture more of that client journey, that client experience, and if the client wants that certainty of exit finance, for example, again, offering that to them. I think you and I both agree privately, we don't want to become a buy-to-let lender. As Zaher says, he's always talked about not liking, never wanting to be that kind of, we do that type of business, but being more like the things that we do, making them more complementary. We're active in the refurbishment space in PBSA. Can we offer a ground up option, for example, rather than trying to, and also I think if you're that new funding relationship, no new funding line wants to work with you and be the guinea pig, the test case for rolling out that new product. they don't want to see you using training wheels.
Yeah.
They if you're going to guarantee someone 150 million a year of flow, they don't want to be waiting 2 years before they start to see the first 50 or 60 million. They want to be seeing by the third or the fourth quarter of that relationship, things absolutely humming.
Yeah.
And so you've got to be doing stuff then, very close to what you're doing, not necessarily trying to learn a new business on the fly.
Yeah.
At someone else's expense. So I guess that's something that I know you're spearheading, and I gather that the initial conversations have been going quite well.
Yeah.
But I think really importantly to emphasise that with our existing funding relationships, they kind of have to come first, because we've got the benefit of over 8 or 9 years of track record with them. We've stood by each other through thick and through thin, and that really matters. That goes a long way, and those businesses also probably could get us to that 350, 400 million on their own anyway. So it's just about a bit of diversification if we do want to expand our funding offering. But I don't know if you want to add anything further to that.
Well, the capital base we have right now are private equity backing. So we have a risk return product that reflects that, and what we're looking for is a different kind of risk return profile. So very much you say we do not want to capitalize on those relationships, and we want to make sure we add something not brand new, but something that's additive to the portfolio and to the product lines that we have. So we do not want to neglect the existing customers that we have, and at the end of the day, we're sort of that weird space where our customers are both our funders and our borrowers alike, and our product are very complementary. So we need to make sure that we can continue to do that, and that's what we do very well, and that's what we like. So definitely those relationships will be absolutely key going forward. We want to cultivate them, and we do not want to steer away from that at all, because that's what we do very, very well.
I suppose going a bit more general. How would you feel? What do you feel has been the biggest challenge you've experienced over the last 9-10 months since you joined the company?
I think it's sort of growing the mindset of the business, because we've done 150 million quite consistently, and I think it's been a good place for the business. We've done okay, but I think when Greg and I joined some 9 months back, and we said, well, we're going to do 150 million this year, having had a bit of a slow start to the year, people were saying, how can we do that? But now we're here, and we're hitting those targets, and we're on track to hit that milestone. And I think is creating that belief, and just consistently every day showing up and being almost looked as a little bit as a crazy person, running around in the town square saying we can absolutely do this because we know we can. And now we're starting to see that belief, people buying into the dream. They see 250 million is not out of the realms of possibility, even though we've never done that before. Is that we grew the lending by 90% in the last 2 quarters of last year. So with that growth, we continue just to see that's very attainable. And it's not growth just been driven by lowering our standards. On the contrary, we've actually heightened our credit standards. We want to be underwriting the right kind of business, but that also means that we're not wasting our own time, our funders' time, or more importantly, our brokers' time, by trying to do deals that we know we don't want to be doing. So having that enhanced focus on writing the right kind of business has been quite helpful from that perspective, and then equally just driving the mindset of the team that everything is done with purpose, and that we believe in the goals we set, and we don't think they're unachievable. We actually think they are very achievable. We just need to be working very hard to get there.
Nice. Well, I mean, having seen it firsthand, I'm confident that you'll continue to light the fires under the management team, and we'll see us hit the numbers that we aspire to. But more importantly, I think is our clients and our brokers and our funding partners, they're more important even than ourselves, that they will see the benefit of that. Yeah. They'll see, the funders will see more flow. The brokers will see their clients' deals go through faster with less friction. I think there's going to be a real, there's going to be a lot of a lot of mutual benefit that's going to come from all that energy and activity. So look forward to seeing how it plays out. Obviously, we don't have a crystal ball over how the year plays out, and I know you talked about the US trying to take over your former homeland's territory, but I think that settled down a bit now. So there'll always be something, won't there? There'll always be some chaos. There's even we've even got at the time of speaking, and who knows, but by the time this comes out, this is all going to be ancient history. We've got a prime minister that's sort of on the ropes. So there's always events, and I guess it's just I think the one thing we as a business are quite well positioned towards, and I think you highlighted it quite early on, is that because the clients that we work with are operator developers in the main, and less, I suppose, what you call investor developers, or which by their nature they're less discretionary. They're buying and building all the time, rain or shine. It does, and the types of schemes as well. That the 3-4 unit scheme in Wiltshire is, as the example, it does insulate you a little bit from the macro, but at the same time, that the macro might not affect the client's demand, but still has an impact on funding and other things like that. So you always have to just watch the space, and you never know where it's going to go. But where we are right now, I think my message to people around Avamore and where you and Greg are taking things is to be excited. Fingers crossed, and let's see how it plays out.
Yeah, definitely.
I suppose we already asked you the usual closing tradition question the last time you and Greg came on about the things you tell your younger self. So maybe we're stealing trigonometry's closing question. What's the one thing in specialist finance that we're not talking about but we should be?
We're not talking about. That's an interesting one. I guess sometimes it's hard to tell borrowers whether or not their deal is any good. I mean, we see a lot, and sometimes we say that deal is never going to make any money. At least that's a bit of a risk-averse view as a developer. I mean, as a debt lender, our very nature is to be conservative in our assumption and run the downside scenarios, but we're not being compensated for taking growth risk, and we take very different kind of risk as a debt provider than an equity provider. And sometimes we're looking at a scheme thinking it's worth less, it's going to cost more to build it, so we can get comfortable because we want to back the developer. Our basis is absolutely fine, but the profit margins are somewhat a bit stretched, and think, well, if they want to take on the risk, we're happy to be supportive, we're happy to work with them, our basis is covered. And then sometimes they absolutely smash it out of the park. Sometimes our assumptions turn out to be correct. So sort of taking that view, but probably that's a thing that, to be honest, thinking about, probably we shouldn't be talking too much about, because as debt lenders, we want to encourage investment, we want to encourage taking the right kind of risks as well. So I think it's just making sure that we're all aligned in what is a debt risk and what is an equity risk, and we don't take the equity risk and being compensated for debt. Yeah,
and I think ultimately, developers by their own nature, if they want to be successful, they do need to have a degree of optimism. Because if they're, I'm sure you'll find very few successful, rich, pessimistic property developers. They probably spend most of their time still looking at particulars and IMs and running cash flows, going, oh, that doesn't work. So maybe we should be thankful for the glass half full nature of property developers.
Exactly.
All right, Jacob, we'll listen on that bombshell. Thank you. Thanks for coming in. If people want to reach out to you, what's the best way for someone to get in touch and chat to you about stuff?
Either via email or through the team. If it's anything to do with deals, I'm not the best person to take it forward. As I said, I'm the glass half empty kind of guy, probably. Well, probably not.
I would disagree with that. For someone on the credit side, you're definitely half full.
Just about. But on email is probably the best, or reach out to the team and they'll make sure that the message gets through to me. We have our RMs on the road. Our asset managers are always talking to our borrowers, and the best kind of business is the one that we do multiple times with the same partners. So repeat business all around, because we know the client knows us, we know what to expect, and hopefully there's more longevity in those relationships. Nice. So yeah. Nice.
Well, once again, thank you for coming in, and of course I've been your host, Michael Dean. You can find me on the internet at property_funder. Thanks as always to Avamore Capital for their continued support and sponsorship of the podcast. Thanks to Matt for his help again on the technical side today. Thanks to Davina, and thanks to Versta for their help in the producing of the show, and we'll talk to you again on the next one. Thanks, and bye bye.